Good afternoon, everybody. Welcome to our Long Options webcast here on the Schwab Coaching Channel, Trader Talks channel. I'm happy to be here with you today. My name is Connie Hill, and we have been getting together at this time to talk about long options. And long options are probably one of the first strategies people try to get to use and to know when they're learning different option strategies. Now, I have a question for you, and that is, how many of you know how to use the Theo Price calculator? Now, that's part one of the question. Part two is, how many of you use the Theo Price calculator to help you decide a strike price? All right, we are going to get into the details of that. I'd love for you to answer me in the chat so we can follow up on that. Now, I am joined in the chat by Cameron May. Cameron's here to help answer some questions maybe I can't get to, so we appreciate Cameron being here. And of course, he's well versed in long option strategies for many, many years. Now, I hope you're following us on X. I'm Connie Hill CS. Cameron is Cameron May CS. We invite you to follow us. It's free to join and free to follow, and we'll, push out little pieces of information throughout the week, things that we might be seeing in charts or news that we think might be helpful for you to be able to see as well and know about. Let's go through our disclosures, and then we'll get into our agenda here today. Options carry a high level of risk and are not suitable for all investors. What we talk about today is intended to be educational and informational. Do not consider it a recommendation. We will be using the thinkorswim downloaded software, Paper Money, to do our example trades here today. It's a very robust version of thinkorswim, and it looks a little bit different than the web or mobile. There is no guarantee that execution of a stop price will be at or near the stop price. We'll talk about that a little bit today. Past performance of any security or strategy does not guarantee future results or success. One thing that is different about Paper Money is you won't be assigned early like you might be in a live market. So we always like to make you aware of that as well. Now I'm going to check over here to the chat and see how many of you are comfortable using the Theo Price calculator and which ones maybe not. So Richard, you are. That's good to see. Stephen, I think you do. Kevin says, I use it with every trade. Excellent. All right. I'm happy to see this. David uses it occasionally. All right. And Peter, you've never used it. So we're going to have a wide variety of skill levels here, but I want the person that's just being exposed to it today to be able to pick up on it just as easily as Kevin, who uses it on every trade. Although Kevin may be a little faster than you are, but I don't want you to be lost. All right. When we have our class here, we always talk about how long options work and what the idea is with trading them. So we'll always talk about the concepts of price, time, and volatility in relationship to the price of an option. And of course, we're going to look at several examples here today. Now, long options are directional. What does that mean? It means we need the stock to move, either up or down, whatever direction we're suspecting it might go. We need it to move. We need it to move fairly quickly. If it doesn't move fairly quickly for us, then we start getting effects of negative theta. And long options are considered negative theta because as every day passes, a little bit more of the price of that option decays due to time decay. So we always want to be fairly mindful of that. They are typically vega positive. What does that mean? That means if implied volatility goes up, that could increase the price of the option. If it drops, it could decrease the price of an option. So it definitely is a variable, especially when we get around big news events. Then we'll have a tendency to see some implications with that volatility going up or down. And you need to know that whatever you put into the trade, whatever that net debit is, you could possibly lose 100% of it. So always make sure you position size. Don't take on more risk than what your portfolio is comfortable taking. Just very, very judicious about that, okay? Don't think, oh, well, this trade, it looks so much better than that last trade. I am going to double up, right? We don't want to do stuff like that. It's not very helpful to you. Well, let's go out. I want to do a quick survey, not a quick survey, a quick review of some trades we have in progress, but most of the time I want us to spend on the Theo Price calculator. Now, before we jump over to thinkorswim, I do want to bring your attention to the fact that we have some things changing in coaching. This will be the last long options class this year. And next year in January, it's going to move to a new time. The class will be on Tuesdays now instead of Thursdays. Brett Moore is going to be leading that discussion on the long options. And then in this exact spot, then at 3 p.m. Eastern time on Thursdays, we will have Getting Started with Stock Investing. Typically, that's been done on Friday afternoons. Instead, it's going to be done on Thursdays at this time. So we always want to make sure that you're aware of the changes that are coming up. If you want to see what the schedule looks like, come over here, log into your Schwab account, come into Schwab Coaching, and it'll bring you to this screen. And then you can just come down and select on where the live webcasts are. Go ahead, view the calendar, and I'm just going to move mine ahead to January, which is what you'd want to do so you can see what the new schedule is. So if I come over here to, say, Tuesday, then this is where we have long options slated right there. Okay, so that's where you will want to come back to. And again, hopefully you have this bookmarked so it's easy for you to go find what you're looking for. Since we're on a web browser page, I also am just going to encourage you, if you haven't done so already, to subscribe to our Trader Talks network. It makes it so much easier for you to find our content if you do and you like to be on YouTube, right? So we'll have all the playlists for each of the classes will be listed there. If you want to go through over the holidays and do some binge watching, fabulous. This makes it easy for you to do that, okay? We have some other playlists put together for you as well. So just going to encourage you to take advantage of that. Now let's jump over here to Thinkorswim and let's look at, we've actually got 4 stocks we're going to take a quick look at. And maybe let's shorten this time frame here. Okay, we are in 6 months. That's good. All right. So here are the certain long options that we have in this class. 3 of them were from last week. And then we've got this other one, Rocket Lab, that was from 2 weeks ago. Now, Rocket Lab is the one that maybe is not faring quite as well as the rest, but we still have 29 days. We don't want to hold it till the 29th hour or the 29th day in the last hour, but we just know we have a little bit more time to work with. So we're down 22, 23%. It's not overly concerning as we look at the chart here. Get that chart up here. I'm going to zoom in. I've highlighted the date we got into the trade. We're looking at, it looked like it was maybe doing a nice little bounce here. We had a hold. It looked like it closed above the high of the low day. And then we looked at it last week and it just kind of was going sideways. And the comment was, we're going to give it a little bit more time, but if it just continues to not do a whole lot for us, then we may have to close it down if it doesn't make half the move in half the time. So we still have probably till, a little bit into next week, but not for very much of it. Okay. Yeah, the markets are going to be having some abbreviated sessions. And if it just continues to not do a whole lot, we might close it down just to preserve what we have left in the trade and not let it get eaten by time decay, because time decay occurs more rapidly when we say are 30 days out from an expiration date versus 60 days or 90 days out. When it's out further in time, you don't really feel the time decay element as much. Okay, so that's our Rocket Lab. Now, our other trades, last week we talked about LEAPS contracts, and each of these trades were long-term anticipatory trades that we did on this. The acronym is LEAPS on that. And so let me just show you. It looks like Boeing held up pretty well. Boeing actually was our possible value play that it's been beaten up. Maybe it had some time to recover. All of these have the same date. We are out here to the January of 2026. Okay, so more than a month or more than a year out. We have oodles of time. And the idea with all of these trades is to let them run up and pull back and run up and pull back and stay in them as long as the trend continues to perform for us. We might end up rolling them at a certain point. But the idea is not a quick play. Like some of the stuff we look at is really a quick play. None of these would really fall into that. But if it were to break a significant trend, all of a sudden started downward trending on it, then we may consider getting out. All right. Let's just take a quick look at the chart. Here's Boeing. and all you can see kind of what it had been doing. You guys have probably listened to the news on Boeing, and it hadn't been so cheery, but they seem to have found some footing, started to make higher highs and higher lows. So we got in here. Here's our nice rally up. Yesterday, it did not really budge a whole lot. I mean, it started up here, and it definitely gave back the gains of the day. But compared to a lot of stocks, man, that one really held in there quite well. So not surprised we're profitable on it. Let's look at CCL. Again, we've got another over 1 year time frame on that option. And we are down a little bit on it when we looked at the monitor tab. We got in here, and it did get a little beat up yesterday. Not nearly as bad as some other things did, and it's trying to recover here today a little bit. Looks like they're going to have some earnings on tomorrow. All right, so we were aware of this when we got into the trade, and when you're holding something for you're intending to hold it for a long period of time, sometimes you'll just have to hold over earnings. Otherwise, you can't let the winning trade run if you're always getting out before earnings. And so our intent is to stay in even over earnings. Now, the last one that we did was Kroger. Actually, I think that was probably the first one we did was Kroger. And what was interesting with it is we got in here, and it had made a move outside of this channel, and it was a little bit risky whether it would continue to go or if it would pull back. You can see it's pulled back. Oh, I zoomed in a little too far. I want to show you. Notice how the midpoint of this channel kind of has been acting as support and resistance for the stock. So sure enough, came down here. Where did it go to? The midpoint of the channel. Looks like it's trying to bounce here. Again, we're planning to let it run up, pull back, stay in it until maybe we need to roll it because our option is not very efficient anymore, or possibly we think the trend is maybe over with, and so we want to get out either to preserve some profits or minimize your losses on it. Okay, those are our 4 trades. All right, let's talk about what I really want to spend a lot of time on today here, and that's the Theo Price Calculator. Now we can leave it on Kroger here for a minute. No, we won't. Let's go to our first example that we're going to look at here today. We are going to look at STX. Now, some technology companies are still doing fairly well. There's others that are really struggling, and Seagate Technology, hardware company, they are struggling. We can see what's happened over the last few months. The red line is a 30-day moving average. This blue line is a 10-day moving average. And so you can see just fairly recently the 10 moving average, well, it looks like it has been below the 30 for quite a bit of time, tried to rally up there a little bit, it's pulling back. Now, it's really sitting at some lows it hasn't seen for a while, meaning the stock. If we come back here, let's look at a 2-year chart and zoom in here, we can see it really hasn't been down in this area for a while. As I zoomed in on a 2-year chart, and it looks like, maybe it may have a bit more to fall to maybe this 84-ish area. Some of you might draw it even a little bit lower. Maybe it turns out to be 83 or something like that. In any case, what we're seeing in it is what? A break of the most recent support level. So it had this support back here in August, and just today is going through it. Okay, so what we're going to do is we're going to use the Theo Price Calculator. If you don't know how to use it, you're going to learn how to use it. But our purpose is maybe going to help us define what strike price we might be most interested in. And I am going to have you guys do the choosing. I am going to have you do the vote, or I'm going to have you vote, and then whichever one I think maybe has the most votes on it, that's the trade we'll actually do. All right, so come over here to the trade tab. You have to make sure you have a Theo Price column selected. Now, in my setup, I have a special column set that has most of the stuff I like to see. All right, so most of the stuff I like to see on many trades, it's not exclusive, okay? But I like to see what the delta is. I like to see the open interest. You know, I'm a stickler for that. You've got to have open interest. And then a probability out of the money might be used sometimes with vertical trades. And then this last column here is Theo price. And if you have Theo price selected here, then you will have on your screen this little box pop up. But if you haven't got Theo price as a column, it will not show up. Okay, so it's tied directly to you selecting the Theo price as a column. And then it gives us a little calculator. What the calculator does is says, go ahead and, you know, tell us what you think may happen in this trade. What are you expecting? And then based on what we are expecting, it's going to come back with a value and say, okay, roughly, not cut in stone, not in cement, not certain, but maybe roughly the price of the option would be in this area based on your assumptions. Okay, how handy would that be to maybe have an idea of that? Kevin said he uses it all the time. You know, that makes me a little, really on the giddy side, a little happy that you have found so much use from it that you rely on it on your trades. Okay, we are going to do something here. We have some options we could do with STX. You can see it has some weeklies and of course some monthlies. Now here, how long do you think it might take to make this move? I mean, we know many times stocks drop faster than they go up, but it's never a certainty. Yeah, this is kind of a big move down here today. I would expect that maybe what it has still to drop. Let me see where I started at, because I think we may have to change this up a little bit. My initial target was going to be 84.12, and we have gone way past that. So we may actually back up a little bit further. If we're at 88, I was looking for our target to get down to about 84. In fact, 84.12 is where I had it. So we still have about $4 more, where it is right now at 88.16. Okay, if it were to drop $4 more for us, and then how quickly might that occur? Now, usually when we're buying long options, we'll say, how much time is it going to take to make the move? And then add on an additional month worth. An additional month's worth of time gives us that buffer, all right? That buffer against time decay, right? Because the closer we get to options expiration, the quicker that decay occurs. So giving ourselves a buffer can be helpful. Now, as we look over here at the options, I'm going to tell you realistically, here's the January options that expire on the 17th, and those are 29 days. So it's kind of like at our threshold where we typically like to add on additional time. I won't take you through it, but the weeklies here are just not that liquid. Okay, we have to go out to February to get some decent liquidity. We're going to be doing a long put here. Okay, decent liquidity for that. Now, you might look at this and you might say, well, you know, maybe normally I might go for the at the money 90 strike. It's only got 64 contracts. And if you're somebody who trades a lot of contracts at once, this may not be enough open interest for you. If you're maybe going to do 1 or 2 contracts, maybe it would be okay. All right. Although down here, going a little deeper in the money, 1,800 contracts probably is a lot more comfortable feeling, right? That you could get in and out easily. Well, what if you kind of are not feeling very happy about your choices here? Could we still consider maybe going back to these January options? Well, one thing we can do to help with that time decay is we can go deeper in the money. We can go deeper in the money and in terms of buying, and then therefore buy a lot more intrinsic value than time value. Okay, that would definitely help ease that burden. So let's look at that. I'm going to scroll down here, get closer to at the money, and let's show you the calculator. Now I'm going to hit reset, okay? And basically we're going to say, all right, how much time do we think it's going to take to make the move? Now I'm looking at short moves here. I don't want it to last until the 27th, but that's the date we're going to plug in here, okay? I am secretly, I guess not secretly, if I'm telling you, I'm hoping that it makes the move, you know, in 2 or 3 days, maybe 4. Okay, but we'll go come out here and we'll put Friday the 27th. That gives us a week and a little time. All right. Then what we say is, well, how big of a move are we expecting? All right. Well, looking at it, we're looking for maybe an additional $4 drop here. Okay, if we can get an additional $4 drop, so I'm going to put in a -4. That's going to do some adjusting. And then if we have a reason to adjust implied volatility, this is volatility and not volume, then we might put something in there. Like if a stock is coming into earnings in a couple of weeks, we might ramp up volatility. If we go back and look at the chart, and that's why I had it listed on the chart so we could kind of see what was going on with implied volatility. As stocks drop in value, many times we'll see the implied volatility go up. This is not really going up that much. It's staying pretty even. And so if you're like, I don't know that it would actually go up or down in this case, we're just going to leave it alone. We won't put anything in that field to adjust. But if you have a reason to, absolutely use it. In this case, it might go up a little bit, but I don't want to be too optimistic on our option and say, oh, it's going to go up 8 points or 10 points or whatever. Okay, we're just going to leave it alone. So as we come back to our trade tab, and just note, we're not going to put anything there. We're looking for a drop to be almost to $84, okay? Which, based on where that next level of support could be, it's going to be around 84, maybe 83 even. All right. Next, we just look at the column, our Theo price column, and we see, based on our what ifs, this is what we think the price of the option could be. Okay, not guaranteed. And it's just kind of like in a vacuum with just those two variables changing. Count for time decay with the date, count to the price actually moving. Okay, so let's suppose you said, well, I want to maybe do a little bit in the money to help create a buffer for that time decay, right? Because we're maybe not going to go out to February because we weren't so enchanted with the open interest, but we've got plenty of open interest here. What if we went a little in the money? And let's say this is a 56 delta and this is a 67 delta. So depending on how deep in the money you wanted to go, you could choose possibly one of these options. And let's just look and see what we think might be best. Okay, we don't obviously know for sure every time what's going to be best. But let's suppose we start with the 92.50 at a price of $6. Okay, we would buy the option for roughly $6. Maybe we can get it at midpoint. That would be lovely, but not guaranteed. And based on our assumptions, this is saying, well, the price of the option theoretically could be in the neighborhood of $8.67. Okay, that would be an increase in the value of $2.67. Okay, so I'm going to put $2.67 into the calculator, and then we're just going to divide it by what we think the price might be. Okay, so we're going to divide that by 600. Oh, I actually should have just done $6, not 600. I shouldn't have multiplied it out. So basically, we take away those two decimals, okay? And we'll just do it better here. That was going to be let's see, what did we say here? $6 was our price, and it was $8.63, so it was $2.63, right? I think it's changed just a little bit. We'll go $2.63, divide that by 6 even, okay? That tells us it's about a 43% increase. Now, some of you might go, okay, maybe not so bad for a few days worth of time. Okay, so I'm going to put this first one here, which is the 92.50. And we're going to say it has a gain of about 2.63, which is about 43%. Okay, so those are just the real rough details here. Get that over there where it goes on the percent. All right, next up, what if you said, well, maybe we don't have to go that deep in the money. Maybe we could do a 90. All right, what would the 90 be priced at? Well, maybe something in the neighborhood of 450. And the value on that option goes up $2.08 roughly. Okay, so an increase of 208. in terms of a different price, right, from our cost base or our cost price, our net debit, to what the theoretical price is. It's 208. If we divide 208 by the ask price, that of 450, so a little bit less, that's about a 46% return. So not monumental. Let's put the 90 strike price here, and then we'll put it in here, 46%. Okay. Of those two choices, do you feel strongly one way or the other about it? You know, if you go a little bit deeper in the money and the option starts to maybe dwindle on you a little bit, they have a little bit of a buffer there. With the 90 option, we have a little bit of intrinsic value, not quite $2. Okay. And so that one might cost you less, but the return percent is about the same. So for your preference, what would you prefer? Would you prefer, I'm going to say 1 is the 9250 and 2 is the 90 on this one. Okay. You let me know how your vote is. And I'm going to go queue both of them up. We'll put in the 90 and the 9250, and then I'm only going to send on one of these. All right, we're just going to do I should have maybe just changed this to a blast all, but it won't matter. We're just going to send it in as a single order. Okay, any preferences there? Go ahead, let me know. Let me get back at some of these questions while your answers come in. Kevin says, I assume the Theo price is using the Monte Carlo price model versus simple Black-Scholes model. Does anyone know for sure what they're using? Now, Cameron did respond to that it does use the Black-Scholes model. It's one of the more popular ones. When you get over to the Analyze tab, if you want to use a different model, you can, and you can change it on there. Okay, but that's what it's using. Okay, Greg says 2, Richard says 2, Sharon says the 9250, so she's option 1. Okay, so we've got maybe some saying go a little bit more conservative here, or a little bit more aggressive, right? The 90 strike price, and Sharon's being a little bit more, I'm going to say maybe a little more conservative, not a huge deal. Okay, there were more votes for 2, so that's the one we're going to use. We're going to do, let's see if I did that right. Yeah, we'll get rid of the 9250. Adios. And we're just going to send in this particular option. Now, will we put a stop on this? Yeah, we would want to put a stop on this, right? Some people will say, well, at least half the price of the option that they might start, there is a beginning stop in case things, reverse very quickly and suddenly you'd want to get stopped out, okay? So in this case, let's do this. Let's do a first trigger sequential. We're going to create that opposite order and put it in as a get us out of order, okay? The price gets down to $3. Now, alternatively, what somebody could do is they could also use the Theo price calculator to say, well, what would the price of the option be if maybe the option made a certain move? Maybe you say, well, if it comes and closes above, say, what its high price was today, or even this green line, you could say in our calculator, well, what if the price goes up? In this case, we could say up to about, let's just call it round numbers, 91. It goes from 88 to 91. That's a $3 potential difference in the price of the stock. And then you could go into your Theo price and say, okay, what would that mean for me? And so we would just do the opposite here. We would say price goes up plus $3. And if it goes against you, many times it might do it fairly quickly. So we may not even have a date out here this long. We might even say something here like let's say 24th in the morning. Okay. Don't know how many of you would be trading the 24th in the morning. Okay. But we could put in those variables and say, okay, the opposite way then, if it did pop up and it did it by before Christmas, or the market closes for the Christmas holiday, then what would the price of the option be? And you could put in your stop based on that, as opposed, and whatever that value calculates to, as opposed to, say, this 50% price. Okay. In this case, it would be, we're going with the 92.50. So it's saying the value of that option would go from about $6 to $3.79. Okay. $3.79, $3.78. Again, it's theoretical. It's not guaranteed, but it gives you the ability to say, okay, well, what if it does this? What could possibilities mean? Okay. You'd be able to stop yourself out a little bit sooner on that. All right. Let me make sure that we are up to date on the questions here, and I think we probably are. Okay, let's go ahead. We're going to put it in to our long options bucket. Now, we haven't had a chance, really. The market's been so bullish. We haven't had a chance, really, to do a lot of puts, buying long puts. We just haven't had really market conditions. And not necessarily saying it's time to go searching for a lot of puts, right? You want to follow the trend of the overall market, but we're seeing enough weakness in the market that there could be some opportunities. And I kind of wanted to combine the two today, giving us some experience using puts as well as the Theo price calculator. So let's take a look at another one here. You know, when you're picking on something to drop, basically look for that trend to already be in place, right? We want to pick on a loser that's losing, right? We want to take advantage of that. We want to take the ride with them. CVS health stores, you probably have some in your community. We have some in ours. They've really been struggling. They have, Walgreens has. And as I looked at this, the thought was, well, if we go lower, how far do we have to go back in time to get that low? And we have to go back pretty far on CVS. So what I decided to do, and I'll just kind of get rid of this for a moment, is I decided to use a Fibonacci on it. Let's review this, and then I'll put it in play in front of you. If we're looking for something to drop, then we're going to start at the bottom part of the move so it'll project downwards. When we're doing something where we think the stock is going up and we're projecting upwards, then typically we start at the bottom of the move. Okay, so in this one, I'm going to start here. This is the move we're going to be doing. And I'm just going to get to the highest point here. Oh, I went the wrong way. The lowest point here to the highest point here. And that's probably close enough. It's 60.64. And this high was 60.47, so that's pretty close. Okay, we're within 3 pennies. Well, this would give a potential target if it used the Fibonacci. We don't know if it will or it won't, right? But we're going to use this 39.74-ish area as our target. Now, if you wanted to make it a little bit shorter, you know, make it $40, you know, coming up a little bit, you know, it's kind of rounding up there a little bit, you can do that. In fact, let's do that. Okay, so this next one, our how much we think is going to drop. We're going to go from essentially 44 down to 40. Okay, so another $4 move. Again, how long might it take? Well, we're expecting it to drop pretty quick. I mean, you come back here and you see what has happened here. It's had a pretty steep drop fairly quickly. It's not guaranteed that it's going to continue to do that, all right? But we're seeing weakness in this stock, and we're seeing some bearish moves here. Okay, so we're going to go to our calculator on CVS. And again, we have some possibilities here. We have some weeklies and we have some monthlies. Now, I'm just going to open this real quickly so you can see the kind of open interest we're seeing here. So if we went out 43 days worth of time, depending on what strike you might choose, there might be okay to open interest here, right? We said maybe it's going to take a week and we want to give it a little bit of a buffer, maybe that January 31st date, and going at a 44 strike price might be appropriate. Let's go plug in our values in the calculator. Okay, we're going to look for another drop of $4. And instead of being the 24th, let's go give it out there to December 27th. Okay, so looking after Christmas to come back, looking for some continued weakness. I know we're going to have Black Friday numbers, right? Those will get reported. Some retailers might have some trading activity. go ahead and we'll leave volatility alone as well. Why are we going to leave it alone? Just to not be too optimistic, but this one, can you see how it's been going up here when the price has been dropping? We weren't seeing that on Seagate, but on CVS, we are seeing implied volatility rise. So if somebody said, you know, I think it's going to go up more, I think implied volatility might go up. It has a drop from here to here. Let's see where it currently is. It currently is at 0.52. You know, what if it were to go to 0.60? Let's put some scale on here. All right, that's about 0.60. That could be feasible. All right, let's say that implied volatility is going to increase 10 percentage points. Okay, so in our calculator, back on the trade tab, we're going to fill that in, and we're going to say implied volatility is going to go up. And it's based on what we would put as a percentage. That number that we were looking, the 55 or 51 right now. I think it maybe could go to 0.60. Okay, it's just a small 10-point move. It's nothing tremendous. Okay, we could add that in there. If you want to be more conservative, then you might just leave it alone. Say, I don't want to change the implied volatility. Let's look at maybe worst case scenario that it doesn't do anything. Okay, so we'll leave that alone. Let's see what our numbers look like. Now, if we're looking at, say, the January 31s, giving a little bit more time, and I'm going to give us a little bit of room here on the side. Possibilities here. Let's go 31 of January, and let's maybe go with that 44 strike price. Okay, that's just our, well, yeah, that's our at the money right now. It's right at 44. Okay, if you want to be more conservative, go a little bit in the money. Maybe if you're not so concerned about time decay here, because we do have some contracts that have a little bit more time available, then you might not feel the need to go as deep in the money. Okay, so here's our 44. It's going to cost us roughly $3. Okay, $2.98. We'll just round up. And the price of the option moves to about $5. So in that case, we're looking for a $2 move on an option that might cost us $2.98. All right, what does that give us? Well, that gives us about a 67% return. So some traders might feel like, okay, I like that. Again, if you're maybe a little bit more concerned about time and how far in the money you might go, you could come out here further to the February options. Okay, not a problem doing that. We're going to pay a little bit more for them, and we don't have single dollar increments like we have on the weeklies. So that's why the weeklies might be more favorable to some. Okay, so that's our January 31. What if you're aggressive and you're like, I just don't want to go out that far. I want to do January 17th. Okay, we don't have a 44 strike here. We do have a 45. And that would be really considered our at the money strike here with a little bit of intrinsic value. Okay, would cost $2.80. And what would it go to? $2.80 up to $5.26. So that's going to be what, about $2.40. Let's go $2.40 roughly. Okay. All right, $2.40 would be the increase in the price of the option if indeed it fell $4 and it was by the 27th. All right, then, so our $2.40, divide that by 276. It's fluttering around here on us, but we'll go 2.76, gives us about an 86% return. Again, theoretical, if we were to maybe do something with less time, okay? And getting a little bit of intrinsic value. This has a 53, a 54 delta. Again, somebody could go in a little deeper. And if you wanted to be maybe a little bit safer, you could do that, right? Because you'd be buying more intrinsic value and less time value. Okay, well, I want you to vote on this one, okay? This is CVS, and we're looking at a couple different time frames. And this one on the January 17, we're going to go with the 45 strike. And like I said, it's about an 86% return in a vacuum, theoretical, not guaranteed. Again, sometimes things fall more quickly than they rise. This has a little bit that it could drop here too, right? It's 43 down to 43 and change, almost to 40, or it took 40 as our target. All right, do you have a significant preference of one over the other using the Theo price calculator? All right, I know it takes a minute for you to get my question and then for you to respond and it to come back to me, okay? Now, what I would say on CVS is it has, the results here on STX were really tight. There wasn't a big differentiator. Being 2 weeks separate from each other, right? Because these January 31s are 2 weeks further out, then it does give, I think, a little bit more of a differentiator versus if we did, say, a 45 here in January and did like 47.50 that was a little bit deeper, then I think those numbers would have come out pretty even with each other. Or closer, much closer than what we're seeing here, 86.67. All right, so go ahead and vote. Do you want number 1 would be the January 17 option. Number 2 is going to be the January 31st option. Okay, trying to get as close to the same strike price as we can, but just giving us a little bit more money. So Greg says you like number 1 better, going out a little bit sooner or getting the contract without as much time on it. Okay, David likes number 1. We'll see if anybody else wants to weigh in here. So far, Greg and David are gonna lead our choice here, possibly. All right, Mariana says you like maybe number 2 better, and there's really not a right or a wrong. We know that probably the probabilities, if we were to come and look at the delta, that's going to maybe give us an idea of how much of a probability the option would expire, at least a penny in the money, right? So on this January 45, that's about a 51% chance. And on the January here, we did the 44 strike. That's about a 44 delta. Okay, but again, we have a couple more weeks worth of time. All right, number 1, Ricebird votes for number 1. Okay, we're going to go with vote number 1, but I appreciate all of you voting here. Oh, okay, Ricebird. Now we got Michael. Michael likes that number 1 choice as well. We'll open up and get maybe just a little bit of intrinsic value here, a little bit deeper in the money to help give us a buffer that we might appreciate as far as time decay goes. Same thing here. You could do the theoretical price calculator to say, well, what if the price of the stock went to and reversed, right? You might say, hey, if it gets back above yesterday's high, this thing isn't dropping like we expected it to. Or somebody could go to this Fibonacci level and say, if it gets beyond that level, then maybe they would want to adjust it based on the price of the option. Again, plugging that in the Theo price calculator. For our purposes, we're going to kind of do the generic thing and just say we're going to put a stop about 50% the price of the option. So we'll just say buy a custom with a stop. And actually, we could do an OCO. We should do an OCO here, buy custom with OCO, because we already know what our target is. All right, so we are going to say our stop is going to be based about on what, $1.25 would be our 50%. But then our target, let's make both of these good till cancel. And our target is going to be based on either that we could put in the price of the stock or we could put it in the price of the option. We'll go ahead and we'll plug it in the price of the option, which is in the neighborhood of about 485. Okay, I know that number's changed slightly as the numbers have been bouncing around, but we'll go ahead and put it in for what we think the value of the option could be. And if it gets there sooner, great. Happier campers are we if it maybe hits that target earlier than we possibly expected. Okay, let's go ahead. We're going to hit a confirm and send here. Put this to our long options bucket and send it on its way. Now, let's see. Hungry for God says you're looking for puts. Yeah, we are looking on this right-hand side, which are all the puts. Again, we've spent most of our time on the call side of things with a little bit of weakness in the market. decided, all right, let's give us an opportunity to look at puts and also explore that Theo price calculator. Now, those of you that haven't been exposed to it or haven't been using it, how many of you feel like, yeah, I can start using that. I can go add the Theo price column. I know I can just click right there and put in assumptions. Now, when you hit reset, it starts it all over at 0. So don't put in your assumptions and hit reset. Just put in your assumptions and press enter. Okay? Well, let me know if you feel more comfortable with that. I certainly hope all of you do. It's kind of an eye-opener when you think, well, maybe you see something you think is good and you put in the numbers in the Theo price calculator, and then you're like, oh, I don't know if it's really worth it. Maybe that wasn't as good as a trade as I thought. Okay, it can really help you make those kinds of decisions. All right, so we did talk about our options in relationship to price, time, and volatility, and the theoretical price should things change. So you guys, again, this is the last long options class for 2024. I am going to track those trades anyway, see how they do. I'll be tracking our LEAPS contracts as well. And remember, next time this class meets, it's going to be on Tuesday. So go out to the calendar, find that. It'll be on Tuesdays at 1 p.m. Eastern time. All right. Have a great holiday season, everyone. Cameron, thank you for your help. Don't forget to subscribe. Don't forget to follow us. There was no survey out there today, so you're off the hook for that. Have a great holiday season, you guys. We'll see you next year. Bye-bye.